Cool. We're live. Thanks for tuning in. It's Money Monday, and it's me, Shani. I know you already know who I am, but I'm just letting you know, just in case you're looking in from another page. All right, so today we're going to be talking about stocks and bonds, right? I get a lot of questions by email, also within my DM, asking whether or not if it's a good time to be investing in the market. And we are all about person empowerment. So I have one of my boss bays who is a financial advisor. Her name is Sky Maduro, and she's going to be talking about some of the trends and ins and spins as it relates to stocks and bonds amid COVID. So if you have any questions about investing, you can drop those questions in the comment section. But as always, before we start the show, we want to make sure that one thing happens, that you open up your spiritual purse, which exists in your mind, okay? And then we're going to ask that you open up your spiritual bank account if you can relate to that one. And I want you to imagine that we're going to send you some money, honey, okay? Because I want you to feel valued every time that you connect with me. So if you're ready, open up your spiritual purse, open up your actual purse, whichever purse that you connect to, and imagine this money coming right at you. For those of you that watch the show, sometimes I always get that right and sometimes I always get that wrong. All right, Sky, let's bring Sky on. Let's get this conversation chopping and stopping. Hey, did you feel richer after that, Sky? Did you feel richer?
Listen, I felt like I took a bath in $100 bills. Like, I felt that. It got a little wind going by over there.
I know. Sometimes it be hating, but this week it was like...
It was.
They must know. They must know. They must know. All right. So, Sky, let's get into it. We will have a conversation at a few different investment levels. We'll have it at starters. We'll have it at intermediate. And then we'll have it at those that already have an account and things that you're seeing in trends like that. So, obviously, the market, just like every part of the economy, has been impacted by COVID. So, when you're talking to a lot of your clients that have 401ks with their employers, right? What type of things are you recommending for them to do if they have a 401k with their employer and that's the investment that they have at this time?
Well, one of the things I'm telling them to do is make sure that they're watching it. Okay. Are you watching it? Are you noticing whether you're losing money, if it's stable, or if it's going down? And based upon what you find when you're looking at your statements, I'm asking them to rebalance, reallocate, because most people don't know this, but yes, you have a 401k on your job, but you can go in and reallocate your funds. You don't have to take what they just give you, because if you are not going in and rebalancing it or reallocating it, then they're just giving you whatever, and then you have to deal with how the market flows, the ebbs and flow of the market. But if you go in, most accounts allow you to log in and access your 401k so that you can reallocate the funds. And I'm telling them to reallocate it in something that's less risky, because the market is very volatile at this time. So invested in something that's less risky so that we're not experiencing such huge dips in the money that we've acquired.
Okay, so for someone who is looking at their account, which you mentioned, because that is one of the things, especially that I get with my clients, they're always saying that, okay, Shani, all I'm doing is I'm looking at the loss, and I just go ahead and take all of the money out. And what would you say to that? I'm always saying no, but what would you say to that as someone who actually advises on investments?
Yeah, no, don't take it all out. and you know what? Well, wait. It depends on who I'm talking to. Are you 70 or are you 27? So it depends on who I'm talking to and where you are in your process of being closer to coming off the workforce and no longer having earned income. So it depends on who I'm talking to. But if you have a few, more years in the workforce, don't take it out, reallocate it, put it in something less risky, something like treasury bills or notes or corporate bonds or dividends. Put it in something that's safe while you're still working, so you're not seeing it disappear.
Got it. Okay, so you would say reallocate in the event. Hey, Vanessa, if you got a
Dr.
question, drop
Walker.
it in the comment section. Maybe we need to
Yeah.
get you on here to talk about some chiropractic
Yes.
in COVID, right? I'll call you, V. I'll call you. All right, so that okay, so you're definitely saying reallocate. Okay, you would
Yeah.
say reallocate. The other question is, okay, so you also mentioned that if you're closer to retirement, then that's
Yes.
an
That's a
indicator that you
different conversation.
definitely, that's a different type of conversation.
Yes.
Okay. The next question that I would ask would be for a lot of people who are able to save at this time and they are just getting into the market in terms of making more individual
Okay.
investments.
Okay.
It's not necessarily tied to their employer. This is something
Mhm.
that they're, doing. What are some recommendations that you might have for someone who is just getting their foot wet when it comes to starting to invest?
Okay, so because of where we are right now in our climate, again, my conversation is always predicated on who I'm talking to and what their situation is. But if I'm giving some general information because of where we are with our climate, what I'm saying to people is have your basics in order. Okay, identify where you are, know and embrace that truth. Are you still employed? Is your job stable? Have you invested very well with your employer? Do you have savings 6 to 12 months, 8 to 12 months rather, of savings? And if so, if you're, then yes, invest. You're going to be doing stuff like a Roth IRA, or you're going to be doing like a money market account. Those are the two things that I would say if you want to step outside of an employer or if you're self-employed, those are the things that you want to open up: a money market, a Roth IRA. And
Even in this market, Sky, even in this
yep,
market, you would still say that at this time it's really good um to be investing in a money market where we know for sure you're just, you're going to get pennies on a dollar, even in this market, you're
yeah,
just going to
yeah.
get that.
Yep, yeah, because the reason why I say a money market is because your checking account isn't giving you anything. Your savings account isn't giving you anything. The stock market is very volatile. So if we're going to plug some finances somewhere, let's plug it where it's safe, but yet it's still yielding us something as opposed to the mattress.
Okay. All right. So now I know for sure. Hold on, we got a question in. We'll go back to mine. If I have a 401k with a company, it would you
Open
also
it.
suggest me opening a brokerage and a Roth? Okay.
If if you have 8 to 12 months of emergency fund, if you are managing your debt to income and you're paying down debt and you have money left over, yes, I would suggest that you do a Roth IRA and you invest it with very low risk at this time. Nothing very aggressive, but
What
very low risk.
why it seems like right now like you're really encouraging low risk at this time, yeah, why are you advocating for low risk at this time?
Well, I've been in the market for some years and I've lost a lot of money.
Yeah, me too.
um, I've lost money when we were heading for recessions, when the market was very volatile. I've lost a ton of money and it's hard to recover from that. So, from my experience, I would much rather someone put it in something low risk where they wouldn't lose a lot of their principal. They might lose a little if the market takes a spiral downturn, but you're not going to lose all of your principal and you'll have enough time to recover when the market corrects, because the market's always going to correct. But you want to have something in there for when it does correct so you can make back what you lost and then some. But if you keep it in an aggressive fund, if you keep it in something that you're risking making a lot of money with your principal, you could lose 80%, 70%, 60%, and then deal with the emotions of that and now having to recover.
Okay, so another question. I know this question came like closer to the time when it was closer to the time when the when the checks were getting sent out, the 1,200,
Stimulus.
1,500. Yeah, the stimulus check. I couldn't even think of the name. So many of my clients were getting a stimulus check, and now that they're in this middle ground about getting another president, so now there's more talk about maybe we're gonna get a stimulus check, and some of my clients were even reaching out to me, asking me, Shani, with that one, they wanted to know if they should invest. So if and when there is another one, how do you feel about that as someone who, basically considering it a level up move to take like this $1,500 and start investing it in the market? What are your thoughts about that?
If I'm talking to someone who has the basics in place,
yes,
make the money work for you. You're going to come out better when you make the money work for you than when you just become a consumer. Because when you're a consumer, it's here today, it's gone tomorrow. But when you're an investor, what you want to do is have your basics in order. So when extra money shows up, you can put it to work for you, and you can have it bring its friends to come and play with you.
Got it. So in that event, so I guess we differ a little bit in that regard, because like, I do understand what you mean by, okay, you have your basics in place. So now you got this extra $1,500. Even in this type of economy, would I recommend that you start, buying, individual, stocks and bonds?
Yeah, no.
Yeah, that was my question, though.
I didn't hear individual stocks. I heard invest.
Yeah,
that's very broad. Invest is broad.
Yeah. That's what I was talking about, because
all right. So individual stocks, you have to be a day trader if you're buying individual stocks. And a day trader means you're there 9:30 when the market opens, and you're there 3-4 o'clock when the market closes. You have to watch it, and you have to be able to move. If you're working a job, running a business, taking care of a family, you can't sit and day trade and buy individual stock, because if you're taking $1,500, we're not talking about a lot of money. We're not talking about a lot of money to buy individual stock with, because let's take, for instance, Tesla. Tesla just made the S&P 500 today. The S&P 500 is the top 500 companies in the United States of America that have to bring in at least $2.8 billion in revenue. So they just made it today. But one of their stocks is close to $500, right? So you have to assess what you're willing to lose. And yes, this money just came to you. You didn't earn it, but it was yours, and you don't want to throw it away. So if you're not watching the market, if you don't understand how to look at the 52-week highs, if you don't know how to read whether it's going to go up or go down, or watching the news, buying individual stocks could end up hurting you, because you can lose what you originally invest. So I wouldn't do an individual stock if you're starting out. Definitely if you're starting out and you don't have the time to sit and watch and study and learn.
Okay, so if I'm just getting started and I'm seeing all of this information online, social media, because you know what happens when there's ever a come up, it doesn't matter whether if it's a come up in, you get your income tax or you get a stimulus check, whatever it is, if there's some type of, trend income come up at this time, people start badgering each other about what to do with the money, it gets aggressive online, and they start really pushing people to start investing, and they say you should be doing this. So if I'm hearing some of that information and I have my basics in order, I have my 6 to 9 months, I have a debt elimination plan in place, how should I start? I'm hearing all this information, so it's making me like, okay, maybe I should tip over and start doing a little bit more investing outside of what I have in my 401k, my 403b, SRS, those things like that. Where should I get started?
So I would definitely look at accounts like a Roth IRA or a money management, money management account, where you're hiring companies. Like, there's companies out there, and I wrote them down so I wouldn't forget them, but they're managed accounts that you can open online, and these managed accounts come with investment advice. And you can start with little money. Like, so if you're getting $1,500, you may say, I feel safe taking $300 to play with the stock market. And then I feel safe taking 500 to invest in a managed account that gives me investment advice that kind of has like a robo advisor. And these companies are like Betterment, Stockpile, Stash. These companies also offer you to buy stocks at a fraction. Remember, I just said Tesla is like close to $500. Well, they allow you to buy a fraction of the stock because you may not have that much, but you're dabbling in it and you're learning. And you might take 300 to dabble with, and it was from your stimulus check. So if you lost 50 of it, you wouldn't feel as bad, right? So I would recommend a managed account online with an investment advisor, a robo advisor, with companies like that. And they also have the option where if you're liking how it's going, where you can start adding money to your account every week, every 2 weeks, as needed, so you can grow those accounts as you're learning. And that's a managed account in companies like Betterment, Stockpile, and Stash. And definitely, a Roth IRA, you can open with a couple $1,000. That's your own investment. That's something you can add to every year. It also has some tax advantages depending on what your situation is, what your tax bracket is. But that's a go-to for me as well for some of my clients.
I like that. That was some good solid advice on getting started and just starting to understand. So we covered a few grounds for those of you who are tuned in. We started off the conversation of talking about just some simple ways to get into the market. Scott is very helpful at that. We'll also drop the names of some of those. Acorn is another one, another great starter account to get started on when it becomes to investing. We also talked about whether or not how aggressive you should be being in this COVID, do you think of micro savings like Acorn? Yeah, we just mentioned Acorn. Yeah, totally. I'm for Acorn, 100%. Yeah. So we were just covering some of that. So for those of you who have any specific questions about getting started on investing, to get in the market, looking at your 401ks, if you're looking at it constantly, you're kind of seeing that it's going down. We gave out a few things that you can do right at the beginning to get started on that. So here's another question that I like to cover, especially for the entrepreneurs. Oftentimes they're trying to stabilize their income. Mm-hmm. It's always that whole process of stabilizing your income as an entrepreneur, right? And sometimes it may be a little bit more demanding in the COVID economy. So what are some recommendations that you give for people that are climbing in their income? What are some advice that you would give to people climbing in their income? And they're like, I can't invest with this little bit of money. I can't invest with this little bit of money.
Oh my goodness, you can start with a little bit of money. And that's why I recommended the management accounts. Like I have people that would come to me as an advisor and want to give me $2,000. And I really can't do anything with that because there's a lot of fees associated with hiring a broker or
about how much money do you is for you in terms of your ideal clients, usually, because we talked about that segmentation, but usually how much money, look at that smile on your face. You're so funny. You know what's coming.
I'm like, are you really asking this?
Yeah, you know what's coming. Okay. So for you, what income level do you like for your clients to come to you at? What is the income level?
Well, it's not about an income level so much because I have to tell you something, Shani. Some of my best clients are clients that make $50,000 a year, but are good savers and they know how to put money away and they know how to budget. Because sometimes the people that are making 150, 200,000, they're very wasteful and they don't have much to work with. So it's not so much about the income as it is about the habit. And so there's people that make a lot of money that have very bad habits, and there's people that make little 50, 60, 70, 80,000 that have very good habits. So it's not an income level. It's where you are. And so a lot of my clients I'm helping them start out, and I can help them start out with a good life insurance policy too. That's another way to invest with a cash value. So a life insurance policy with cash value that goes into the market, that grows for you and allows you to borrow against it should you need it. So you're not dealing with interest rates when you're borrowing from a bank. You could borrow from yourself. You could pay yourself back if you choose, or you can leave it that way. That's a good start if you don't have 200 grand to bring me, 100 grand to bring me to invest for you. So we'll start growing with the life insurance with cash value. I'll advise you to probably do the managed account online, grow that, because then when it grows to a certain amount, then you can bring it over to someone who can manage it for you and invest it.
Wonderful. We got two great questions moving. Really great
Yes.
one. We're gonna go with say Aisha. Her questions is, at what rate of loss should we start considering reallocation within our company sponsored 401k portfolio?
So it depends on how much money you have in your account. So if you're looking at what your balance is, and you see that maybe 25%, and 25%, 15%, you're seeing a huge dip, because sometimes the market takes a big dip and you see a huge chunk go down. Anytime you see it go down in a recession like this, I would reallocate it. And even when there is more so when there's a recession, but when there's not a recession coming, you want to watch it, and there's a variance. Like, we can lose about 5 to 10% in a year and still be okay, because we're going to recover it the next year. But when you start seeing the dips go down after that 5 to 10%, and you're at 20, 15, it's like, all right, so let's go into the safer allocations. Let's go into the ones that are offering more stabilizations, that are close to like bonds and treasury bills and dividend paying kinds of stocks and things like that. So it depends on how much you have and where you are in how close you are to coming out, and your age. There's so many different variables, but I always tell someone to look at where you are at about that 5 to 10% mark. In between there, start watching it closely and reallocating it.
Great question. We also have a question from Vanessa. It's, at what amount do you consider transferring your money from Acorn, or just keeping them
it
there for long
long-term?
term? Yeah. At what dollar amount do you say, okay, it's time to get off of that Acorn, sis?
Right. So, I mean, it all depends on what you're looking for. If you feel like with Acorn, you're growing, you get the response that you want, and you feel comfortable there, let it fly. But if you're looking for a little bit more savvy advice, looking to diversify, looking to spread your wings a little bit, once you get like at about 80 grand, 100 grand and up, I would definitely, if you're looking to grow and diversify and go to the next level, I would definitely look at interviewing investment advisors.
Speaking of interviewing investment advisors, what are some recommendations that you can give to individuals tuning in that's now, at the place where, maybe they can't, do the Acorn because they don't understand it enough. They see the savings, but, they still don't have the intellectual sophistication to move the money around. And they would just like, or they don't have the discipline of someone who day trades. So it's like, you know what, I'm making the money, I'd like to just hire a financial advisor. What are some lookouts that you would recommend to them?
So you would want to look for someone who's definitely in tune with you, who you feel like understands you, who listens to you. Because I heard so many clients that have come to me say, man, you're so patient, man, you listen, man, you actually care, as opposed to dealing with someone who's very crisp and hard and doesn't have time for you. So I would interview, ask a few questions like, how long have you been doing this? Right. And, what's your biggest portfolio? Like, what are you managing? What are some of the suggestions that you would give someone starting out? And just, I like interviewing people. I'll do it myself because it's good to get another perspective. I'll go in like I'm a prospective client and ask questions, because sometimes you'll get some insight, sometimes you'll get some advice, sometimes you'll get a perspective that you didn't know of. So I would definitely make appointments, ask questions, feel the vibe, and see how well they are with listening, and what kind of suggestions they have to give you and what their style is.
Yeah, I think one of the top questions to ask someone that you're interviewing, number one, no matter what it is that I'm shopping for, whether it's a car, a house, a doctor, I'm always going to do 3. That's
Okay.
always it, because I'm always going to have a
Minimum.
conversation. I'm going to learn something from this one that I didn't learn from that one. I'm going to play these 2 by each other and probably end up negotiating the prices, you know, in the
Yep.
basis of that. The other question I would always recommend is, how do you get paid? You know,
Yep.
oftentimes people don't know how their financial advisor gets paid, whether they're fee-based or service-based. You know, that is a very important thing. Can you kind of talk about the differentials between
So,
how you guys get paid?
so it depends on the product and what you're doing. So if I'm managing an account for you, then there's a percentage coming out of your account to pay me, because I'm managing the account. So I'm watching it for you because you can't watch it. And so I'm managing for you. So there's some points that come off of what you have in there that come to me, whether you make money or not, I'm getting that fee. Right. So that's the way the managed account works. Now, if you're buying a product like a life insurance, or you're buying some sort of another product, like, you know, long-term care or something like that, then the company for which you buy that product from, that I'm contracted with, pays me a commission. So it depends on whether it's a service or if it's a product. So services, the fees generally come from you, and the products, the commission comes from the company from which you're purchasing the product.
Okay, so that gives you guys some understanding of, just to know, hey, Shika, that gives you some understanding in terms of how a financial advisor will get paid, whether or not they're taking a percentage of your money. It's always really clear, because sometimes there's always this sticker shock when you look back at your income and you're like, what? You know, so that's a whole process. For those of you that are tuned in, I just want you guys to know that we are having a digital Friendsgiving. I'm going to drop the link, right? So we're going to have a chef that's going to come in, because I love to have these money conversations. I do, right? But life is not just about the expenses. It's not, it's really about the experiences.
Yes.
So I am going to drop the link for those of you that are tuning. We're having a cooking class with a vegan chef. So while we're talking about money and we're talking about gratitude, we're talking about what to do with it, I want to make sure that you keep a clear mind, a clear heart, and a lot of creativity, because that's what gets you to show up to these conversations and kind of stick through them, even when you don't fully understand it and there's some bits and pieces. Much of my financial education just came in sitting in conversations when I didn't know what was being talked about, wrote down a couple of notes, went home, researched it, and then, you know, came to my understanding. So I do want to drop that there for you, just in case some of the conversations like, what you say, sis? That way in that regard. So we talked about, you know, how you're, you know, how an advisor can get paid. And interesting enough, Sky, when we talk about this, you know, you and I, we have this conversation all the time. You always getting your feelings about it. So I'm about to get you in your feelings again. But there's this whole ideology, and hopefully this time when we have it, you'll take it from a different place. I can tell me, like, when you're hearing like this, you like, she about to get on my nerves. But anyway, right? So there's this whole idea in terms of, so me, really and truly, when it comes to like anything that I'm purchasing, like almost under 50 bucks, right? For me, my purchase is really not going to be on like whether or not if I kind of like this person or not. Like, I've just seen a lot of people, yeah, like even if I have good chemistry with you, it doesn't necessarily mean that like I want to patronize your business, because I've seen a lot of people shafted in that regard, you know, like they get into this personality whole thing, and because you lack that, even me, when I'm working directly with my clients, I say, don't fall for me, fall in love with my results. Fall in love with my deliverables. Don't fall in love with like my personality, because I want them to take that with them from one transaction to the next, so that you're just financially astute, know how to ask good questions, and know what's kind of going on with your money. So in terms of selecting a financial advisor, I do think that, you know, bar none, this is someone that you need to understand, because you can sit in a conversation with someone financially and just leave the conversation feeling dumber than when you got there. You're like, what? There's absolutely no relatability. So I do believe that relatability does need to be there. I do. That definitely, you need to understand the person. You need to feel like you can ask them questions. You need to feel like you can have access to them. So that's great. But the other part is it, we'll get right to that one. The other part is it, what would you say to people who need another layer of certifying their financial advisor? What is another layer? Like, where can they go? Is there a place that they can go and research and kind of look at their advisor's history or anything like that? What's some recommendations?
Yeah. So there's a website you can go to, And I don't know why I just drew a blank, but it's kind of like where you could go look up realtors on the website. You could go look up life insurance agents on the website. Well, for licensed advisors, investment advisors, you can go see if there's been any claims, any complaints. You could also see if they have anything reporting negatively on their credit report. All of that is right there on the website. And if you give me a second, it's going to come to me. The website's going to come to me. I don't
Okay.
frequent it.
So when
I'll
the website comes to you, we're gonna we'll just drop it in the comment section. Even if you just say it, Natasha will drop it in the notes for us, so that you guys can have another layer of being able to certify whether or not, if this person has a bunch of complaints. It's like the Better Business Bureaus for financial advisors. You can just type their names in, and you can see whether or not, if there's been like a lot of reports on them, if they they've had issues with licensing. You can be able to verify if they're actually licensed.
Broker check.
Say that again.
Sorry, broker check. It's called broker check through FINRA. Yes.
Okay. Yes, FINRA. Yeah.
Yeah.
Perfect.
Broker check.
Broker check is where you would go to.
Yeah.
Just so once you do, I do think that relatability is one of the first layers to be able to communicate with someone and to know what they're talking about. They speak their language, blah, blah, blah. Yeah, but you want to be able to have another layer. Okay, so this is going to be our last question that's coming from Vanessa, Dr. V. She says, I'm very grateful for my financial advisor, but before I had one, I would always hear a broker will make you broker. Sky, can you share the benefits of having a broker?
Oh my God, I love the little face that pops
Me
up.
too. You saw the faces, Dr. V. He's doing too much.
Yeah, I mean, a broker could make you broker, and people like to blame their broker for the market. But when you're investing on your own and the market tanks, do you blame yourself? You probably do. You probably beat yourself up. So the broker is the middleman, typically, who has a little bit more experience, who is diversifying for you, who's watching your pennies for you. And if you're with the right broker, they will give you the advice, even if it means that they're losing their fees, because they'll advise you to do something else. And so that's why it's always good to watch your statements and see what's happening with your money, and give the broker a call and say, hey, I noticed this. What do you recommend? And if they're honest, they'll probably tell you, hey, get out of this managed account, put it over here, because of how the market is going. If they're not honest, they'll probably say, oh, it'll correct, I guess, because they'll drain it and they'll get all their fees, they'll get all their money, and you'll be stuck. So I could understand why people would say that. But in every field, every institution, you have some good apples and you have some bad apples. So
right. And I think what has to happen is that you learn how to pick apples. Once you learn how to pick apples, and then it kind of lessens, those losses for you, knowing how to pick an apple, not having unrealistic expectations. I think because a lot of the noise and people watch, get a little bit of information from this place and that place, and then they create these big expectations, thinking they're going to get these 18, 19, 20% gains. And it doesn't always happen that way. Sometimes you're getting an 18, 19, 20% loss. So that would be that. We hope that you guys have enjoyed this conversation. Sky, we will drop your IG in the comment section if you have any specific questions. Again, we're going to be cooking together. It's a digital forensic giving. So for those of you who would like to connect during some cooking, we have dropped that. It's a completely free class. It's not something that you pay for, because it's not just about the money that you're making. It's also about the experiences that you are creating. Yes, right? So I do hope that you guys were able to pick up at least one thing to add some value to your purse. Sky, as always, I do thank you for spending this time with us and sharing some information as it relates to getting started when it comes to investing, how to move around some of our resources, what questions to ask. So we do thank you. And if you'd like to cook with us, you're free. You can come. It's on us, sis. It's on us.
Really? I'm invited.
You invited. We dropped the link. Okay, so next week, right? So, Scott, for those of you for next week, just to let you guys know, if you have enjoyed this conversation, we're going to be talking even more about some more investing next week. For those of you who are more for individual investing, okay? So we're going to have a day trader that's going to come on. So for those of you, it's going to be Money Monday at 7 o'clock. We're always here. So if you have some questions, you can drop those in the comment sections, and we'll build it out for next week. Until next week.
Ah!